everyone. In this video, we are going to discuss about the portfolio managers. Okay, so this is a series in which we are going to study the basic knowledge of the how portfolio manager manage the portfolios and how the portfolios work and everything about the portfolio and portfolio managers. So in this video, the first chapter is ours, the investment. Okay, so first chapter is our investment. So let's start this video. So first of all, my name is Lokesh Koyaka and you watching the Lokesh Koyaka YouTube channel. So what is an investment? People earn money and spend money. They pass through various phases in their life cycle. During some phases, they earn more money than they spend. In other phases, they earn less than they spend. Therefore, sometimes they have to borrow money to meet their fall, and the other times they end up having a surplus money, as can be seen in the exhibit 1.1. Rarely, the income and expenditure of an individual household match. In this, the given the life in this the investment. What is investment in this first year? The booklet that the money in people's life cycle, the money earned and money spent earned by a user or a household will be high. Earned money will be high compared to the its expenditure. Sometimes in some phases the money earned by an individual is lower as compared to the its expenditure, to which he need to borrow the money to meet its shortfall expenditure, means short term expenditure to go on the business or life. So here, to show the life cycle pattern of the household life cycle pattern. Okay, here the booklet given the exhibit 1.1 for this to explain about the life cycle pattern of savings for an households. Okay, so here first, income and expenditure. Okay, spend, income and expend. Here it is an income. We need to write here it is our expenditure. Okay, here the scale is in dollars. RS is the Indian rupee. Okay, okay, Indian rupee. You can also assume it is as here you can assume USD or CAD or okay. So here the these the zigzag in the first you see in the graph is the life of uh, previously continued from the so and so date, after so and so date. Okay, so first the job, so rest life is keeping in the zigzag, and the first jobs from the graph started. So first job. Okay, so borrowing. Here we see the curve. Okay, here jobs. Here it is the retirement. The retirement ends. Okay, jobs ends, and the here see that the first money will be borrowed, next money will be repaid, and savings in retirements and after drawings on the savings, means it is saying that the in beginning the j- jobs, uh, before the job, the first job, they will borrow the money, next they repay and saves the money for the retirement, and they borrows loans money repayment, and after that in retirement they will start withdrawing the savings. Okay, so okay, so here it has been given to we need to keep the amount income and the expenditure to know. So the people has broadly two options to utilize their savings. They can either keep in they can either keep it with them until their consumption requirement exceeds their income. So here it is saying the people has broadly two options, usually two two options to utilize their savings. They can either uh, keep it them units their consumption to util their consumption requirements existing their income, or they can pass on their savings, uh, passing on their savings to those who requirement exist where their income with the conditions and returning it back with some uh, increment. There are therefore those who consume more than their current income must be willing to pay more than what they receive to those who have provided the fund. So here, especially the people makes a trade-off between the postponing their current consumptions and the expanded higher amount expected amount higher higher amount for the future consumption. The difference between the two is the referred as a return. Okay, next this 1.11 savings versus investments. It is common to use the term savings and investment interchangeably. However, they are not one of the same. Savings is just a difference between money earned and money spent. Money spent. Investment is earned commitment of savings with an expectation of receiving higher amount of committed savings. Investment involves some specific time period. It is uh, process of making the savings work for to generate returns. So here it is saying that difference between the savings and investment. So savings is that when the amount we has been left after expending money, the earned amount which is left is called as saving. Investment is the current committed amount means the amount which is invested finance instrument which is committed means which is after particular years uh, it generates some returns, higher returns, the amount then the investor has been invested in that instrument. So the higher amount is on the come from appreciation or interest dividend like this, so and so forms it will come. Okay, so hence uh, pe- hence when the peoples are savings, they use these short term deposit securities, which is highly liquidate assets. On the other hand, people are investing their committed funds to the real assets, capital market securities such as bond securities, bond stocks, and other long-term assets. Committed are not be as liquid as short-term assets. See the box point one to understand the difference. Find real assets. The object. Secondly, the of survival and savior and difference. Uh, the saviors tended to accum- accumulate the funds to address short-term goals, whereas the investors has long-term goals such as the building retirement corpus or the fund for funding children college education expenditure. The choice of investing, hence every investor is server but ser- is server but not vice versa. So here it is saying that the investor, there is investor is the person who invests is called investor, and the savings is goals. It is done. It is kept in the so, the money is saved in a bank account or if, any uh, bank locker or in lockers or meet their short-term goals. Okay, see, and the investment is done by investors to meet their long-term goals, um, like the buying, saving money for the investment, saving money for the retirement fund, children's education expenditures, and buying house or car, like this, so and so. Okay, so let's see the box one for the real financial assets versus the real assets. Okay, so this can be broadly categorized as the financial assets such as shares, debentures, bank deposit, public provident funds, mutual fund investing, and the uh, physical assets, tangible assets such as the gold, diamonds, precious metals, and real estate. Financial assets has advantages of liquidity, flexibility, convenience, convention, convenience of investing, and else of maintenance management, and they are also primarily invest income generating investment, though the same of them some of them such as equity oriented investments are held for the long-term capital appreciation. There is a greater else of investing edge edge of the investing in such assets as it follows from small and frequently investment. So here the investment, so broadly classified, as everyone knows, the assets has been classified broadly into two: tangible assets and intangible assets, or we can say financial assets or the physical assets. Okay, so what is financial assets? So financial assets, you can say the intangible assets. Both are same, means both are also known as financial assets, is also known as the intangible assets. Okay, so finance are the examples of the bonds, bank receipts, treasury bills, mutual funds, provident fund, public public means, sorry, provident fund, not provident. Okay, so what it means? So this is the money on the paper. Okay, it's the finance and generate funds, but it also has the risk backed. See, in finance field, in finance investing, or in finance, there is the investment and the returns and the risk as the two relationship. Means if the risk is high, then the return will be high. Then if the risk is low, then the return will be also low. Okay, so as we discuss about what is the financial asset, now we are discussing about the what is physical assets or the tangible assets. So physical assets are those assets which can be see. Okay, which has the value and or the precious metals. Okay, so physical assets example is the earth, gold, diamonds, and other precious metals, and real estate. Okay, which can be see, which can be touch, which can be we feel, and which has the value. See, financial assets, physical assets, both has its own value, but the main difference is that these assets, the financial assets, is on the paper wealth, and the physical assets are the real wealth, which has the real value by every in go in you go to every corner of the world by go taking gold to any corner of the world from any country, see the price the gold has its value. But if you buy the debenture of the country, like India's companies country India company Indian companies bond, and you go and exchange it to the person who is sitting in the bond of India, it the person who is not interested bond, okay, in exchange he not give you money, okay. So that is the according to me, in simple words, okay. Next we see investment versus speculations, okay. Another term which need to be distribute investment is speculation. Investment speculation actively are so intermediated, that is why that is very difficult to distinguish and separate them. An attempt can be made to distinguish between the speculation and investment. So investment on the basis of critical, like the investment is time horizon and the process of decision making, okay. So investment is the time horizon, okay. Investment is the time horizon, cat criteria criteria category. So investment is the time horizon and the process of decision making, okay. Whereas the finance occurs on the time commit continuum, ranking macro milliseconds, okay. Macro millisecond, macro millisecond, minutes, hours, day, week, months, years, decades, centuries, and perpetual period. This is the uh, tendency to describe the short-term activity as the uh, uh, as the spec, speculative speculative in the nature and the long-term ownership of the asset as in, okay, which is not appropriate. There is a tendency to describe short-term activities as speculative and in nature, and the long-term ownership of the asset as the investment, okay. So and another popular way to define the speculation is by expanding the dictionary meaning defection defection meaning of the same. Defect, defectory meaning of the term speculation is the or conjecture without firm evidence. The activity of investment involves the carrying out any exercise of pos- of processing to determine the value of an uh, asset, and they buys the one whose the value is determined to be higher than the current market value. More, however, while one speculating, one is motivated to undertake risk which is not active, not commensurate, non with the rate in anticipation of gains with the minimum research and the analyzing on the true value of the asset. Yeah. Okay. Next, investment objective. So most of the investors invest with the goal in mind regarding the value of the investment at the end of the uh, time investment period. The investment objective are the investors' goal expressing in the risk return liquidity preference. Some investors may have the tendency to express solely on the basis of return. They must be encouraged to stay their goal in terms of the both risk and the return. The expressing goal only in terms of returns may be led to inappreciated asset allocation and adoption of risky investment assets. Give to themselves. An investor may want her to double up by the end of the year. However, she must be made to understand that much a goal would be external risk the risky. Okay, the investors must be explained that the investors must be explained that the risks returns and not the other way. Okay, any other way. Okay, hence a detailed analysis of risk appetite of an investor, in her willingness and ability to uh, take the risk should be processed, and decision of discharged returns. Okay, the returns objective may be simplified as follows. So here it is saying that the objective of the investors to objective of investors objective. So investments objective. So the main objective of an investor to invest money is to meet its goal. The goal every has to meet the every goal. Okay, so investor will first analyze at the period at which he want to achieve goal. Then he plans to. Then he uh, wrote. Then he keep in mind that the investment period should be in so and so period because I need to achieve the goal in so and so period, and what is the rate of return that the investor need to get to achieve its goal. So the main objective of an investor is and achieve its goal. The every investor in this world wants to double its money. Okay, double its wealth. The wealth, the increasement of wealth is depends upon the risk is involved. Okay. Next we see the below following. The returns objectives can be the follow. First, capital preservation. So, minimizing or avoiding the chances of erosion in the principal amount of an investment highly investing away avenues high risky avenues. Investors pursues these investment goals as these uh, investment objectives requires no or minimum risk taking. Also, where the funds are required for immediate short-term, investors may set uh, set for capital preservation as the investment objective. So, or avoiding of the chances of erosion in the principal capital means the principal preservation. The first objective of an investment is to capital preservation means the investors try to preserve its capital by the minimizing the risk or the avoiding the risky chances. Okay, so first objective of an investor is to or avoid the chances avoid or you can say minimize the chances of okay risky the investment avenue. Okay, next second one is the capital appreciation. So second objective of an investment is to capital appreciation. In an appreciation investment objective for this portfolio value to grow over a period of time and are prepared to take risk. This may be an appreciated investment objective for a long-term growth. So, capital appreciation. So, capital appreciation, as its name only says, that the capital means principal. Principal means the amount which we invested in the financial instruments. Financial instruments are the bonds, debentures, gold, real estate. Okay, so the capital appreciation means the appreciation which we get on our investment in case in the many forms like the appreciation on capital or the interest dividends. Okay, next we see next second next what objective the current income. So in an investment objective pursue pursued when the investor wants her portfolio to generate income at a regular intervals by giving uh, by a way of dividend interest rental income rather than the appreciation the value of the portfolio. These investment objectives is mostly pursued pursued by an peoples who are retired and want their portfolios to generate money to meet their life expenditure. So, first objective of an investor is the uh, capital preservation. Second was the objective was the capital appreciation. Third was the current income. So the objective of these some investors is to just to get their money by current income, which means the income which the investment value of the investor which is has been invested. They want to get the money as regular intervals, like in the forms of the dividend or interest rental income. Okay, they some investments like bonds, real estates, and many has the both qualities like the we say that the capital appreciation and they are also get the uh, current in that they get both two benefits like appreciation also and income also regularly at regular intervals. Okay, so next is tax saving. Okay, sometimes the investors do investing in some selective is to reduce their tax burden. This is because the IT authorities provides, which IT means income tax authority, tax benefits in the terms of depreciation, in terms of deductions from the taxable income, or as a some investing in some schemes, some companies, some funds may also give the tax savings in some schemes. Though the first way has been first objective of an investment is the capital appreciation. Second objective is the capital. First is the capital provision. Preservation. Second is the capital appreciation. Third is the current income, and fourth is the tax saving. And next is the for it next is the rate of return. So in the required rate of return. So is committed of rupees for a invest period of time, a pure time of an money for an investor who postpone their current consumption. Okay, so comparison compensation for inflation during the period investment for the change in the general price levels and the risk premium of an uncertainty future payments. So the investment committees for a period of time is earned period of time for time value of an money who postpone their current consumption. So the pure time value of an money for the investor who postpones their current consumption. Okay, so in this it is saying that the pure value of an time is required to calculate for the investor to calculate what is the consumption value after so and so time when its investments gets matured. Okay, and next is as compared to the present day's consumption. Next is the compensation compensation wait next is compensation for the expenditure expansion of inflation during the period of investment for a change in general prices. So the compensation that the investor receives compensation that when the inflation increases what after when it's invested during the period. Okay, in inflation it means the increase in the general prices, or in simple terms the money value will be decreased. Okay, so next is risk premium for an uncertainty of future payments. Okay, so risk premium for uncertainty of the future payments is the third one. Okay, so estimating the required rate of returns. So the rates are required to be written as the by calculating the pure time value of money. Next, the consumption of the expected of investing, and the risk premium of an uncertainty of the future of payment. The price paid for the exchange consumption is the pure rate of an investment. So the price for the exchange between the current emission is the pure rate of interest. If an investor postpones consumption worth 1000 today for generating a future consumption worth 120 rupees, then the pure rate of return of the exchange this is 2%. 100 1020 rupees, 1000 divided by 1000, so we get the 2%. Next, we get the compensation for the postponement of consumption is pure time value of money. It is the refers for the risk-free returns. Return free real risk-free return is adjusted when the inflation is inflation expectation is referred as the nominal risk-free rate. Okay, the nominal risk-free rate of return plus risk premium is the required rate of return. So the consumption for a postponement of the consumption is the pure time value. Okay, of money. It is refers as the real risk-free return. Okay, it is referred as the real risk-free returns. So real risk-free return when an adjustment for an inflation exempt from referred as the nominal risk-free return is the plus of the premium and it is a risk of the return. So required risk of return is the minimum rate of return investor expect when they make an investment decision. It is not noted their required rate of return is not generated return on assumption return. It is also a different from the expected return. It is also a different from the realization return. Okay. So yeah, so I think in this video, this much only we keep. In next video, we will see in detail about the exam estimating the required rate of return. Okay, in detail we see. So thanks for watching this video. I hope this video finds your help. This was the part 1 and part 2 comes soon. Okay, chapters part 2 will be come soon. Follow this playlist from first. Okay, this was the first episode or first part which has been seen of the chapter 1. So let's stop this video here only. Lokesh Koyarkar signing off. We meet in our next video.